In this video, I'm going to talk to you about 3 different ways that you can gift to charity that you might not usually think about, but it's a great way to gift to charity at the end of the year instead of just using cash. Hi, my name is Zach Morris with Paces Ferry Wealth Advisors. And the 3 things that I want to talk to you today about are gifting stock to charity, gifting your required minimum distribution to charity, and also utilizing a charitable gift fund. So the first thing that I want to talk to you about is gifting stock. So not a lot of people are aware that instead of gifting cash, so instead of gifting $1,000 of cash to your favorite charity, you can actually gift appreciated stock. So what's the benefit of that? Giving appreciated stock can actually allow you to take the market value. So if you have a stock that you bought at $100 and it's now worth $200, right? If you were to sell that, you would have to pay tax on the difference. So of course you don't want to sell the stock and then gift to charity, right? Because then you'd have to pay tax on that difference. You can actually give that stock at that higher value, that market value, and you can get a deduction up to that total amount. So there are some limitations on how much you could deduct when you gift appreciated stock, but they're pretty high, and it's based on your adjusted gross income. So let's say you make $500,000 in a year. Your adjusted gross income is $500,000. You can deduct up to $150,000 or 30% of your AGI. The next question you might ask is, how do you give appreciated stock to a charity? Well, if you contact most of the charities that you give to, a lot of them will have a way of gifting stock. So you do what's called a DTC transfer. And a lot of times your financial advisor or the brokerage company that you're working with can handle that transfer for you. And there's typically a form to do so. And you identify the lowest cost basis lot that you have. So if you have that stock that you bought at $100 and now it's worth $200, but you also bought that stock at $180 and it's worth $200, you want to give the lot that you bought at $100. The next strategy I want to discuss with you is that if you're subject to required minimum distributions, so if you're over the age of 70 and a half, it's also been pushed up to 73 for people that haven't started taking required minimum distributions. But if you're taking them, you're aware that you're required to take out a certain amount every year from your IRA based on the balance of your IRA the previous year on December 31st. So if you're subject to required minimum distributions, you can give up to $105,000 this year, and that's indexed for inflation, directly to a charity or multiple charities of your choosing. So the way this works is that you give directly to that charity, and then that counts toward your required minimum distribution. So it's not a deduction in the same way that you imagine you give to charity and then you deduct it on your tax return. But you don't have to realize the income at the end of the year. So when you take a required minimum distribution, let's say for sake of example, your required minimum distribution is $105,000. If you take that required minimum distribution, it's going to raise your taxable income by $105,000. But if you give it all to charity out of your required minimum distribution as a qualified charitable distribution, then it doesn't count as any income on your tax return. The last strategy that I want to talk to you about is called a charitable gift fund, or sometimes referred to as a donor advised fund or a DAF. A charitable gift fund allows you to put in money and get a deduction in the year that it's given to. So the way to think about a charitable gift fund is like a private family foundation or a charitable wallet, except it has a lot less administrative costs and it also has a lot less requirements, right? So if you start a private family foundation, you're going to be required to give 5% of that money away, or else you owe excise tax and penalties. With a charitable gift fund, you're not required to give any amount away in any given year, but you can get a full deduction for the amount that you put in any one year. So let me explain how this works. You open up a charitable gift fund. A lot of custodians only require a $5,000 minimum in order to open a charitable gift fund. When you make that contribution, you get the deduction in the year that the contribution was given, up to certain limits that I'll cover in a moment. For the sake of illustration, let's use the example that we used in the stock gifting for the charitable gift fund. So assume that you make $500,000 in any given year. So your adjusted gross income is $500,000 and you can give $150,000 and get a maximum deduction that year. So the deduction limits on a charitable gift fund for gifts of stock is the same as a public charity. So you have a maximum deduction limit of 30% when you gift into the charitable gift fund with appreciated stock. So in this case, you want to give $150,000 into that gift fund, right? So you give $150,000 in year one. You get a maximum deduction that year. So you get to take that full deduction in year one, and $150,000 goes into the charitable gift fund. That stock is sold at whatever market value it was when it went in, and you pay no taxes on that sale. That money can then be reinvested in a diversified portfolio, and it can grow over time, and you don't have to give it away if you don't want to. The reason that's beneficial is that maybe you have a high income earning year and you want to maximize your deductions this year, but you don't have a charity that you want to give it all to this year. Maybe you're going to retire next year, and you're going to retire next year and your income is going to go down, and so you want to maximize your deductions this year, but again, you don't want to give it all to a single charity this year. Other reasons that you might not want to give it all to a single charity is that maybe you're giving it to your church or your synagogue, and maybe they don't have the ability to handle a $150,000 gift, right? So you know that that's where you want that money to go, but you don't want to give it all to them at once because you want to make sure that they're using it wisely. You want to make sure that they maintain their 501c3 or charitable tax classification. And you also want to make sure that they're doing everything that you want to do. Maybe you change churches or you change synagogues, right? If it's in the charitable gift fund, you can then change where that gift is going every year. The other way to think about giving to a charitable gift fund is that, let's say you're near retirement and you have a high income this year. Let's say it's $500,000, but you like to give $15,000 a year. Right? You like to give $15,000 a year to charity. If you give $15,000 a year in charity in retirement, you may not be able to deduct it because you may not itemize your deductions. Remember, the standard deduction this year, it's around $30,000. If your itemized deductions don't exceed your standard deduction, then you don't get to itemize deductions. You take the standard deduction. So if you have a high income earning year this year, maybe you give 10 years worth of gifts. So you give that $150,000 so you can get that full deduction, and then you just continue to give $15,000 a year for the next 10 years. Let's say you're 63, to use our required minimum distribution example again, and you're going to retire next year. So you put in $150,000 to account for your next 10 years of giving. Then when you reach 73, you start giving out of your required minimum distributions. So now you've maximized your deductions in your high income earning years, and then you start using your required minimum distribution gifting once you have to start taking those. I hope you enjoyed the video. If you did, please give us a thumbs up and subscribe below, and be on the lookout for more videos from this channel. Thank you.